Okay, so let me pull this back up. Okay, so zero DTE crash course. So this is just getting started, because I think there's a couple important rules that are worth knowing about getting started with zero-day options that new traders might not necessarily know. So if you're already an experienced zero DTE degen, this is probably not very helpful or insightful. It's more for people that are like kind of looking to get started, which like I haven't traded a lot of zero-day options, so putting this together was pretty helpful about looking at what to trade, what kind of management style to use, how to look at your account size relative to what you're looking at in the market. So I just kind of like summarized everything here to kind of, give someone who's not super experienced an introduction on how to get started. So to start out, super basic, zero-day option strategies are options that expire the same day. The extrinsic value of an option decays exponentially as it approaches expiration. So that's just one of the mechanics of the extrinsic value of an option. That is basically the difference between the option's market price compared to the amount it would actually be worth if it was executed today. So when implied volatility goes up, that extrinsic value also goes up because investors are willing to pay more for that insurance policy, for that option contract. But as the option approaches expiration, it becomes clearer and clearer what the market value of that option is, which is closer to the value that it would be if it was executed. So that time decay we normally represent with the Greek theta. And that gives you a pretty good representation of how much that option premium is going to change as it approaches expiration. So because you're trading contracts that are going to expire that day, that causes the extrinsic value or that theta to be really, really high. It declines very quickly. And also means that the value of the position is highly volatile. So what this means is that this creates opportunity for volatility traders in a calm market where they would normally get opportunity like once per earnings cycle or once per sell-off or when something dramatic happens in the market, which is not that often. Now with zero-day options, you have opportunity more regularly and high volatility conditions more regularly. But because of the volatility of those positions, you have to be very careful, especially how you set them up, and especially if you're trading in a very small account.
Especially because you can get exercised. No?
Yeah,
depends on the trade you take.
So exactly, which like, again, if you're kind of new to options, especially zero-day options, it might not be very clear because especially if you trade longer term options like 45-day options or 60-day options, a lot of the time you manage the position before they even get close to that zero DTE mark. So the expiration mechanics, I guess, are not something you necessarily pay attention to. And so that's where a lot of these rules are going to come in and be a little bit more relevant.
True.
Yeah. Okay, so for example, this is just comparing the theta between a 1610 SPX iron condor. And you can just see how much more, like how many multiples of theta that you get more with those zero-day options, and how much more volatility that you get with that position, and how much more quickly, I guess, the value of that position changes. So this is just a kind of nice example from data that I pulled maybe like an hour ago, something like that. But really dramatic difference between longer term contracts like 30 DTE, SPX, iron condors, and the zero-day ones. So any questions so far?
Fine.
Cool.
Chat. I don't know if we have any questions.
Yeah, if you have any questions, feel free to throw them in chat because now we're going to move on to choosing an underlying, which is I think one of the most important parts of setting one of these strategies up. Yeah?
Yeah.
Okay. So the most important factors to consider when choosing an underlying for one of these strategies is number one, liquidity, and to an extent IVR, but liquidity is extremely important. We're going to talk about why in a second. Number two is the settlement method. And then number three is the account size and the pattern day trading rule. So for liquidity, let's get over here. For liquidity, it's really important to stick with highly liquid options to be able to get out of the position quickly. So whether you're trading zero-day options or one-day options, and we'll talk about why you might want to do that in a minute, regardless of what you're trading, you want to be able to get out of that position quickly because if because it's so volatile, if you accumulate losses very quickly, you need to be able to get out and protect yourself. So liquidity is a very effective way to make sure that you can get in and out of positions very quickly. So that's number one, or like I think one of the most important, maybe the most important. And then number two is settlement method. So index and futures options tend to be cash settled, while ETF and stock options tend to be physically settled. And this also makes a really big difference depending on your account size, because if something is physically settled, and that expires in the money, that means that you're on the hook for those shares because the settlement requires the delivery of those underlying shares, right? So even though the size of the option might not be small, depending on how that option expires, you might actually be on the hook for a very large number of shares, right? Or a very large dollar amount equating to the number of shares for that position. Something that's cash settled, which is generally preferable for 0-day options, only requires the cash value of the options at expiration. So that's why a lot of 0DTE options traders mostly trade index options. That's the biggest one, is because of the cash settlement. And so again, this is going to change dramatically depending on your account size, but overall, it's much better to trade cash settled 0-day options. Yes?
I actually didn't know that.
See, this is why the little things are important. And so this is, again, why remembering these rules are important. And then also for account size and the pattern day trading rule, this is, again, where the choice of underlying comes in to be pretty important. So for accounts that are less than 25 grand, the pattern day trading rule applies to 0-day options that are managed before they expire, except in the case of futures, Forex, and crypto. So if you put on a 0-day option and then you try to manage it at a loss, like you put in a stop loss and the position gets managed, and you have an account that's under 25K, you'll get hit with the pattern day trading rule, which is not good. But it's exempt for futures, Forex, and crypto. But crypto we're mostly going to focus on futures, just based on availability and that kind of stuff.
And that's where you get on futures, like two main advantages: cash settled, and it's not counts as a pattern day trading. So there you go. It's for people who hate PDT rule like I do, what you could do, and also being like cash against money. Well, what was it? Cash against physically settled. Those are two main advantages.
For sure, exactly. And we're going to summarize a lot of this information on the next slide. But a little trick that you can do if you have a smaller account and you want to be able to trade a larger asset class or a larger number of assets, you can trade 1-day options the day before you actually manage it. So like if I wanted to manage my position tomorrow, or if I wanted to manage my index option and I have a small account, I can put on a 1-day option today and then manage it tomorrow, and that won't count. So that's like a little trick that you can use to get around, because the 1-day and the 0-day options have pretty similar characteristics. So it's a little trick that you can use to get around that. But to kind of summarize how restrictive your situation is going to be, it mostly depends on your account size and your preferred management style. So if you have a large account and you don't care what your management style is going to be, you have the most flexibility. You can usually trade stocks, ETFs, indexes, futures, 0-day options on all of those things. Again, remembering that account, like the position size is really important, but you have the most flexibility when it comes to what you can choose. If you have a small account and you're cool with letting the option expire, then you have some flexibility. So you can usually trade indexes and futures. But if you have a small account and you're looking to actively manage that position, like putting a stop loss in or closing it at a certain amount of credit automatically, then you have very little flexibility and you're pretty much just stuck with the futures. But if you're using that 1 DTE trick, then it can be expanded to indexes and futures. So again, the type of underlying that you choose, apart from position size, is really going to depend on the restrictions of the account and how big that is. Make sense?
Yes.
So that being said, especially with smaller accounts, which is what I'm going to be trading with today, I'm probably going to stick with the futures. I want to trade something that I can close today because, again, with the announcement tomorrow, I'm expecting a lot of volatility to kind of be coming up over the next couple of days at least. So I want something that I can close today and not have to worry about it too much. But hopefully this should summarize sort of like how many options, excuse the pun, you have depending on what your constraints are. Yes?
Yeah, no, totally. I think it's a pretty brief but really good explanation for CRDTs, and you underline the main advantages and disadvantages out of it, like to start getting into them. Basically, my first CRDT I took was on a massive loss. It was a physically settled on SPY, which obviously my account wasn't that big. 100 shares of SPY, next day, big red day, so I ended up losing around $600 in a single day. So I got a main reason now why I need to choose futures and also to avoid the pattern day trading.
For sure. So very important rules, especially with smaller accounts, that you have to keep in mind when you're setting one of these trades up, because I didn't know a lot of these rules when I started trading my 0-day options. Like a year ago is probably when I started dabbling, and I could have gotten screwed a bunch of times, and I mostly got lucky. So I think just bearing this stuff in mind when setting these trades up is pretty important. So that's very general explanation of how to choose an underlying, and then it actually comes to the trade setup. So 0DTE trades are highly volatile engagement trades. They're mostly, I don't want to say for fun, but I would not depend on them for core portfolio growth. It's kind of more like an earnings play where it's a little bit more speculative. So the highest priority when choosing this trade is to maintain a very small position relative to the account size. So because, again, it's an engagement trade, because it's highly volatile, you definitely want to keep the position size small relative to how big your overall account is. And one way to do that pretty effectively is by sticking with defined risk strategies, just because they have capped tail risk, but also because adding wings, for example, to an undefined risk trade can really reduce the position size significantly. And we're going to look at examples of that in a minute. Yeah?
Yep.
Yeah. So example, let's look at a 1610 SPX Iron Condor versus a 16 Delta Strangle. In the Iron Condor's case, so this is roughly a 1610 at the time when I put this on. It's 1.2K in buying power versus the Strangle, which is 86K in buying power. So just capping on those wings, it keeps your pop roughly the same. Like in one situation, the pop is 71%. In the other situation, the pop is 75%. You collect less, but it's like a 98 or 99% reduction in buying power, which is why for people that do trade short 0DT option strategies, a lot of the time they stick with like defined risk, like spreads or Iron Condors. So super duper important here for sure.
Huge difference.
Really big difference. So I'm probably going to be putting on an ES Iron Condor in a minute, and we can take a look at setting that up. The quotes have changed probably pretty significantly since I put this together. So we'll take a look at the markets and see where that's at. When it comes to choosing a management strategy, again, you have to be very careful about not violating the pattern data trading rules, because those, you want to save those for when you're really screwed and not in avoidable situations for sure. But when you're looking to make an active management strategy, assuming that your account and your underlying choice allow it, you can usually close at either a stop loss, a profit target, or a preset duration. And also, Naked Johnny, to your point, if the broker doesn't close the position first. So that's another thing entirely. But for now, we're just going to be talking about different active management strategies. So for a stop loss, general rule, this is also true with larger term contracts, but the lower the stop loss, the more likely it is to be hit, even though the position may be highly likely to profit. There we go. So if you have like a 200% stop loss versus a 5 or 50% stop loss, like it might hit that 50% stop loss many times throughout the day, but still ultimately be profitable. So if you set your stop loss too low, then like in the long term, it tends to lose money. So generally you want the stop loss to be pretty high, and also noting that you never want it to have to be too big in the first place. Again, controlling position size from the get-go is pretty important for number one. Number two is closing it at a profit target. And again, the lower the profit target, the higher the probability of profit. So closing at a profit target of 25% the initial credit versus 50% the initial credit is going to have a smaller average profit, but also just be way more likely to profit. Which in order to like minimize the amount of time you're actually holding one of these trades, might make more sense to have a lower profit target and collect a little bit less, especially because the profits can be so volatile during one of these shorter term trades that if you're collecting a little bit consistently, might be a better strategy. So that's number two. And then number three is at a preset duration. So more conservative traders tend to avoid holding these positions past noon or for more than a few hours. Again, for liquidity concerns, just making sure that they can actually get out of their positions, which is like a little bit more difficult to do towards the end of the day when the positions, like when these 0-day positions become even more volatile. Yes?
Yes.
Any questions?
No, not really. Pretty clear. Great information. Just like Trader said, great info. And like here, talking about the last point, so that's why you prefer to get a cash settled position, because if it were to be at your profit money in the money, so you let that expire and you'll be given the money, no?
If it's in the money.
It's in the money, yes.
So if it expires in the money, then you could be on the hook for shares.
But if you get for example, you're in a index or in the future, you'll be
Yeah, it's cash settled. So it
yes,
just looks
yes.
at the difference of the option value. So you won't actually, which is again why a lot of people trade SPX options. But if you have a smaller account and you're looking to manage it actively, which is again something that more conservative traders tend to do, to have those stop losses in, or to have those profit targets in, or to not hold for more than a few hours, then yeah, looking at the futures products are really like the best option, unless you do the one DTE trick. Make sense?
Yes.
Hopefully this gave you guys a pretty good,
Oh, it was amazing. Yeah, Julia.
Oh, good. Thank you. I'm glad it was helpful. It was also very helpful for me putting this together. So thank you for that.